What's up, guys? This is episode number 1 of Stock Talk. I am Brandon, and this is Cole. We're going to break down everything you guys got to know in the stock market. There's a lot going on right now, so we're going to start out on Tesla. You guys have been seeing Tesla going absolutely crazy the last couple of days. What do you see going on with that, Cole?
Yeah, I don't know. It's something that just isn't very common in the market. You had a lot of, I don't know if it's FOMO, if it's forward looking, what it might be, but people are very excited about the Trump and Elon merger. And we
They're
have
like
seen
best
this
buds
here.
now.
What's that?
They're pretty much like best buds now, huh?
I mean, that's what it is. And I think people are excited to see what's to come. Whether however their political background may be, it's obviously something that has never been seen before in politics. And you have the richest man in the world and Donald Trump as essentially running mates for the United States coming up here in 2025.
Yeah, it's interesting. Like the stock price towards the end of 2021 peaked out at 407 per share, and now we're at roughly 480. It's down a little bit after hours right now. But, I was thinking about this earlier today where it's like the market peaked out, somewhere around 400 a couple years ago. And right now we could just say it's at a similar level. But, a few years ago, the earnings were a lot lower, the revenue was a lot lower, and full self driving was not really on the time horizon. Like it wasn't really foreseeable to be coming soon where it's going to be unsupervised. Elon has guided that for 2025 they will reach unsupervised FSD in California and Texas. So that's a big catalyst that's coming right now. And on top of that, the Optimus robot is now on the time horizon, but it's still probably like 5 years out. So what I'm trying to point to is like if people could claim this valuation is justified back here, which I don't think it was, like that was quote justified with really none of that stuff I just talked about. But now that we have all that stuff coming and it's starting to get priced in right now, it's like, how high can the stock go? It seems like cars are going to be driving themselves and, it's going to be the preferred way because it's going to be cheaper, safer, easier, and you kind of get your time back.
Yeah, I mean, I think it's only a matter of time before the electric vehicles are going to be here. And right now, Tesla is the only one that is here. I know we talked about this before. Is General Motors is the number 2 most sold electric vehicle in the world, or in the United States. I'm sorry, and they're thrilled to sell 32,000 units in a quarter. So if you look at it that way, that you got General Motors thrilled that they're selling 32,000 units in a quarter as EVs, and you have Tesla. What did they sell last quarter? Is it 420,000, I believe? So look at the gap between General Motors, who's number 2, and Tesla, who's number 1. They have everything. They're there. They're 5 steps ahead of everybody else. I think you can make a case that their valuation is okay. I still think it's a little lofty, as you would say, but it's the future, and Elon has that thing running well and ahead of the game. So it
It's
could go.
interesting here what GM stock has done. They went public in 2010 and their stock price they went public at 34 and now it's 51. So not much shareholder value there, huh? They're not really doing too much.
You do got to think that I believe they got bought out and filed bankruptcy back in 2010 under the Obama administration. So that kind of, I don't know what they were prior to that. But yeah, it's not a stock that moves up very well, or doesn't have the volatility as, say, Tesla does.
Yeah, I mean, the number one thing that matters for a stock in the long run is what the earnings growth of the company is going to do. And, GM and Ford and other legacy automakers are kind of viewed as, automakers of the past where you either adapt and you push forward or you just get left behind even more. And like right now with like if you do like an EV versus a gas car, like the price is similar, but Q1 or Q2 of next year, Tesla's supposed to come out with a Model Q that's roughly 25 to 30K. And like the typical person only cares about their monthly payment. They don't care at all. I mean, they care about the car, but like if you could have a car that's 25% cheaper than a typical gas comparable car and the car can drive itself, can you imagine how many more people are going to want that car versus just a regular, ICE car, internal combustion engine car? So I feel like Tesla, Tesla's like is like when the Model T came out, and the legacy automakers are kind of like the horse and carriages, the horse and buggies or whatever, where people were like, there's no way this is going away, and look what happened.
And that's another thing too is, you know, one of the things that these other car dealerships or, these car brands like General Motors, Ford, Chrysler, um, one of the things that I don't think they, I don't think they feel they need to compete with Tesla. I think they're like, okay, hey, we know Tesla's number one. But I think what they're building their background on these e-vehicles or the EV vehicles, I'm sorry, is brand loyalty. For me, I've had nothing but General Motors vehicles my whole life. We grew up in a General Motors town. So I think that's what they really rely on. That's why when you look at, the new Chevy EV Blazer or the Cadillac Lyric or the new Cadillac Optic that's coming out that are EVs, and they have their Super Cruise, they're priced a lot higher than say Tesla and, in the Model Y or the Model 3. And you think to yourself, well, why would I spend more money? I would ask General Motors this question: why would I spend more money for a vehicle that doesn't have as much or a proven history like Tesla? And I think their answer to me would be is brand loyalty, and they would say, hey, the Teslas to us aren't the most appealing. They don't have a lot of things, but they have the computer inside, that could do everything. But I think General Motors' idea would be, hey, we're going to throw out a vehicle that looks really nice. We're going to have a lot of options in it. We're going to keep that same stuff that's had General Motors a number one or two car brand for a long period of time. And we're going to make our EV and price it at the price we want to, and not essentially compete with Tesla. But if they can stay at number two versus all the other brands, they're happy, and they'll maintain that brand loyalty that they have and they've had for a long time.
I mean, just look at right here what you're getting with a Model 3 for the value. Like $300 a month, 3K down, 36-month, 10,000-mile lease. This isn't even including, I mean, you shouldn't include it, but like it is a factor of, gas savings per month, and that'll be different for everybody. But, I personally have a Tesla, and this, in my opinion, right here is the future where these cars are driving themselves. And the typical commute for the typical American to their job is roughly an hour and a half every day. So, if you put a
Is that
value on,
To and from combined?
yeah, it's roughly
Okay.
45 minutes each way as a typical American commute. So it's like if you could get that hour and a half back where maybe, you have to go home and you have to write emails or catch up on things that you got to do on your computer, you can now put your car on autopilot and do that while you're driving home or commuting to work. So, I think the value proposition of buying a Tesla is going to continue to be even higher as FSD gets better. I bought my Tesla 2 years ago, and I remember FSD. It was nerve wracking, and I felt like it would try to kill me. But now it's getting so good that, you know, honestly, it's almost as good as like a human. Like it could do 95% of the drives that I do around town right now with no problem. There is still like the one-off scenarios where it does need help, but it's only going to get better. And if you just assume that same rate of improvement over the next year or so, they're going to achieve unsupervised FSD. So I think, with regards to the stock, yeah, it's definitely lofty right now. And my 2030 price target is $1,200. So the question is like, and I have a bunch of shares of Tesla, and I've been debating like, is the move right now to sell the shares because maybe a dip is going to happen and it'll return to like the $300 or $200 level? Or do you just sit and hold through the volatility? And, if you're confident it's going to hit 1,200 bucks per share and even more, beyond 2030, the move is probably just to hold, because robotaxi and, the full self-driving thing is a really big deal. But think about how big, which it's hard to really wrap your head around now, but think about how big the Optimus robot really is going to be. Like, imagine if you could have a robot cook you breakfast, cook you lunch, do your laundry, clean your house, do whatever you want it to do. That's just personal use cases. Like, imagine like people that work at UPS, for example, where the UPS trucks are going to be driving themselves, and then there's going to be the Optimus robot carrying the package to the front door and leaving it there. Like, it seems far fetched right now, but I think the future is coming whether we want it to or not. And the companies that don't adopt AI and, autonomy, they're going to do okay for the next 5 to 10 years. But the spread beyond that is going to be, they're not going to be able to compete with the people that adopted the AI stuff, because the AI people, the Optimus bot is never going to need a lunch break. It's never going to call out sick. It doesn't need a pension or, health insurance, whatever. It's just going to work 22 hours a day around the clock and never complain. So it's way more efficient and cheaper. So I just think that if you have the guts to hold the stock for the long run and through the volatility, it could be a golden ticket. But don't buy the stock right now and say you only want to hold it for 2 years and hopefully you make money, because I think that's setting up for failure. But if you have a 5-year horizon or longer, you could do really good.
Yeah, I mean, I definitely think the robots are coming. It's crazy to think about. I remember, what was it, 10, 12 years ago, watching iRobot with Will Smith
Yeah.
and thinking, there's no way. This is crazy. You know what I mean? Are they going to have an uprising? What's going to happen? But, looking back then, never would have thought it. And here we are 10, 12 years later. I'm not exactly sure when that movie came out. But here we are, and it's right around the corner. And you look back at the like you mentioned UPS. You look back at the port strike over in New Jersey with all the port workers. Their number one thing was, hey, we don't want these robot or AI managed cranes to do our work. That was their biggest thing. They said, no, we're not going to autonomous. We're not going to get rid of any jobs, and that's what they fought. Meanwhile, these ports are like, hey, man, we could do twice as much or more work with these autonomous cranes or whatever they were to go through. I don't know all the details on it, but that's what they want. That's what they want to do. They want to go to autonomous. It saves them money. I know UPS contract came out 2 years ago, and they were talking about how UPS drivers make $170,000. It costs the company $170,000 per year. Between their health care, between their pension, between their salary, everything that gets thrown in there. Now, if you could have a couple robots do that job, why would UPS not want to make the change? Now, I think it would be a long time before they could get that to fully incorporate. But I do believe that you could have the semi truck drivers that are running from hub to hub. I think all semi drivers could be looking for new jobs shortly, essentially, because if you could get the full FSD working on semis and they're just on a highway, drop lot to drop lot, that's kind of an easy thing, to replace. And I know UPS, I think their UPS Worldport is their airport down in Louisville. And they process 1 million packages an hour. I believe that's the exact number. It's 1 million packages an hour in their fully autonomous warehouse down in Louisville. So you think a bunch of humans could process 1 million packages in an hour? I don't think so. So you have to adapt and you have to get ready for it. And I think some companies will be left behind because they'll be scared to. And I think others that have adapted multiple times will continue to adapt. And we'll be seeing robots. What do you think? I think maybe 10 to 12 years before we actually see them incorporated. What's your timeline?
I mean, it depends on what job description you see them for. Like robots, I mean, there's robots in Amazon warehouses right now, but like robots, like legit walking around delivering packages, I feel like that's like the end of the line stuff where, that's probably 5 years out minimum. Um, but it's coming. I mean, we're definitely going to see it in our lifetime. And I threw up a little comparison here of the S&P 500. That's a VOO versus UPS. This is a 5-year chart, and you could just see that, making a single investment in the S&P 500, you would have vastly outperformed UPS in the last 5 years. UPS did 7%, and the S&P 500 did 87%. So what that's going to do is that's going to put pressure. So UPS is a blue line here. That's going to put pressure on the management team, the board, and the CEO to say, how do we increase revenue? How do we trim expenses? And how do we compete and remain dominant versus FedEx and XPO and Amazon and really whatever other company that's out there, USPS? And if a company like Tesla had a fully developed Optimus bot and would approach UPS and say, "Hey, we could supply you 2 million bots in the next year, and they're going to be able to drive the truck or sit in the autonomous truck that Tesla makes and deliver all the packages for you, and you could pretty much lay off all your employees." It sounds crazy to say, and I'm not saying that's how it would go down, but every single CEO is probably going to say, okay, let's do it. And, people are going to say, well, there's unions and stuff like that. But it's like the union is going to protect the employees until the employees don't have a job, meaning the company's out of business. So if UPS doesn't adopt it, somebody else will that is non-union, and the non-union companies will um, they'll be able to flourish because they'll be able to do the same job for cheaper and more effectively, more safely, and adhere to a time schedule better versus someone had to do a route that day and they called out sick. So let's jump over to Nvidia super quick, and let's talk about what's going on there. So Nvidia's been on an absolute tear. This is a 5-year chart right here. It's up 2,000% in 5 years. 1 year, it's up 160%. Nvidia right now is taking a little bit of a dip. If we put it on a 1-month chart, it is down roughly 7% on a 1-month chart. And, a lot of newbies right now, they're, quote, panicking because Nvidia took a little bit of a dip because, it was like 150-ish and now it's 130. But you got to zoom out and look at the big move that it just made. And I'm not saying this is a bubble. Like the move that Tesla made for, comparison, Tesla's move right here, they didn't grow their earnings or revenue significantly, but Nvidia's earnings and revenue significantly increased in this time period right here. So the valuation is justified. I type out a alpha report, a newsletter every day, and the PE ratio of Tesla right now is 190, and the PE ratio of Nvidia is 55-ish. So what that means is if you were to buy the entire company of Tesla outright, it's a $1.4 trillion market cap company. Let's just say you have $1.4 trillion just laying on the side of the road and you just want to go buy the company somehow. It would take you 190 years for that company at current earnings to be able to make $1.4 trillion. So that is what PE ratio means. So there's no scenario on earth like pretend you're going to go buy a landscaping company. You're not going to buy a landscaping company for $1 million and they only make $1,000 a year in profit. Like if the landscaping company made, a decent amount of profit, like maybe you could get your money back in 20 years. That would be realistic. So that would be a 20 PE. But Nvidia's PE is like roughly 50s, like I said, but they are growing earnings and revenue at double digits year over year. So that justifies Nvidia. And Nvidia is at like a 50p, and there's a lot more to go into valuation. But, Nvidia is the future and it's the backbone of everything. Like the new Blackwell chip is coming out. And I think that Nvidia with chips is going to kind of be like Apple, where you want to upgrade your phone every couple years, where you get the latest and greatest, but then in a couple years it's kind of obsolete-ish. Where in order to run the complex programs that you want to run, you need to have the latest and greatest hardware. And I think that Nvidia is kind of setting itself up for like a super cycle of that. ChatGPT is becoming more complex every day. It needs more compute power. Elon has Grok. Meta's doing one. Google's doing one. I mean, all these people are doing large language models that are going to require a bunch of compute. So I think that Nvidia is a solid long-term hold. I do have positions on Nvidia too. How do you feel about that one?
Yeah, I'm in on Nvidia for sure. I've got positions in on them as well. Um, you know, it's one thing to be first or the first big name, and then there's another thing to be first and continue to be the best. You had BlackBerry, and they were the first, kind of smartphone that came out. Everybody's like, "Oh my gosh, BlackBerry is great!" And then what came out? The iPhone and Android,
Oh,
and they took that and took it to the next level. And I think when you look at yeah, Jesus, I
right
think
when
when
the
you look at
iPhone came
Nvidia,
out.
they took, they came out and now they're continuing to get better and better and better. Whereas, you know, they didn't just come out and then say, "Oh, well, we don't know where to go from next." They have a plan, they've executed it, and they continue to execute it and continue to get better. And yeah, like you said, they're the backbone, they're the future. It's going to continue to grow. And I like Nvidia for the long term. I'm okay with them going down a couple percentage. It's been kind of rough since they're, or not rough, but it's been kind of up and down since they're split a couple months ago. What was it, back in June? Um, so I'm okay with that. But I think it's going to continue to go up, and I think that they're going to continue to get better.
So that's going to lead us perfectly into SMCI. So SMCI basically builds the server racks. So like if you want to build like a large language model like a chat GPT or whatever it may be, you call up NVIDIA and you say, "Hey, I want to get the compute power from you." So they say, "Okay, here's your H100s or your Blackwells, whatever you want to do." But you literally just get the chips. And what SMCI does is that's basically like the entire backbone ecosystem to integrate it. So, just think about an Xbox, for example. They overheat, they need fans, they need a housing, they need to be able to plug into things, they need to be able to connect to each other. So Supermicro is in charge of basically integrating all of these chips into the data centers. And it sounds like a very basic thing, but it's actually very complex because the key is to pack as many in as you can, connect them all together, and keep them cool. And there's rumors that Blackwell, the new Nvidia chip coming out, runs hot. So now it seems like the standard for these data centers and the server racks is to be liquid cooled versus air cooled. Most cars right now, I mean, pretty much every single car right now is liquid cooled because it's more efficient, through the radiator versus just having the wind blow through it and cool it down. Because liquid is more dense, it's better at cooling things down. So Supermicro is kind of top of the line when it comes to that, but they have these issues with their accounting. And you could see the stock, it peaked out March of this year at 114, and now it's trading at 33. And there's been a lot of, different news articles that came out. I think right here on the bottom, there was an article that came out that SMCI received an extension from the NASDAQ to get all their numbers in compliance. And actually, I think that was that little bump right here. Right here was where they hired BDO, the new accounting firm, to go through the books. So they kind of put like investor confidence back in there and kind of like dampen fears of being delisted on a NASDAQ in general. They did just get recently delisted on the NASDAQ index. But like if you go by triple Q, you're not getting any more of SMCI right now. So it's rotated out of the index, but it's still tradable on the NASDAQ. You can see right here on the NASDAQ. But if SMCI gets removed from the NASDAQ, it's going to become very liquid, not liquid. And, I would expect the share price to fall substantially, not only because, it'd be hard to trade in and out, but this is strike two of them being delisted. If you do it once, whatever. If you do it twice, it's kind of like, is this intentional in a way, or what were you really trying to do with this? But on a relative basis, like the stock is trading, assuming all the numbers are good, the stock is cheap. It's trading, SMCI's growth is very similar to Tesla, which is what's funny. You're like the revenue growth and earnings growth, but SMCI's PE ratio is 16. So what that means is if you buy the entire company, so the market cap is 19 billion, If you had $19 billion, you could buy the entire company, and it would take you 16 years to get your money back. So 16 years on SMCI versus 190 years on Tesla. Now, this is based on current earnings and stuff like that. So, Tesla with the full self-driving stuff and the robotaxi network and Optimus, earnings are expected to go way up, but the stock is pretty much pricing in perfection for Tesla, and this does appear cheap. So, I know you have a position on this coal, and I had positions on it too, but I closed them out. What do you think? What do you want to do with this one?
Yeah, so I put my positions in some time ago, back probably around when they were, 18, 19. I think, uh,
I think you got in somewhere around like you
yeah, it was
actually
down.
like
It was
got
down at the bottom.
bottom.
I definitely know. I'm like, yeah, something. It was very undervalued, and I still think it is. The scare, the first part of the scare was the audit, and now them getting pulled off of the Nasdaq 100. And the next thing that could happen is if they do get pulled off of the exchange in total in general. So it is definitely something that is a concern. But I think if they come through and everything and they get back and everything looks good and their accounting numbers look good, and they stay on the Nasdaq exchange, I could see this stock going up. They have earnings, they have everything they need. I guess they're kind of sloppy, if that's a word. They're sloppy with how they report, how they do things. If they
Yeah.
tighten that all up, stay on the Nasdaq exchange, um, I don't know if they could get back to 115 or 114 or whatever they were, but I definitely could see them growing and becoming to a more stable value. Um, Maybe in the 60s. I think.
What do
I'm not
you
too sure.
what percent of your portfolio do you allocate to this? I mean, do you do a lot of your portfolio or just a little bit here?
Oh, just a little bit. Majority of my portfolio is in the VOO, S&P, and the triple Q, IWM. I think staying with those, especially the VOO, is my favorite. But I do like to have equities, in other things, a small percentage of my portfolio and other things. Um, Companies that I like or companies that I could see have quality and have the ability to maintain a long-term sustainability. So, but yeah, just something small. I just, there's some things that maybe don't cross my mind, and then it gets so to a point where it's so undervalued. It's like, I think you have to buy, and that's kind of how I was with Supermicro.
Yeah, I like that analysis. I mean, it's a small percent of your portfolio, so even if it does go to zero, which would be extremely unlikely, but if it were to drop substantially, it's not an amount of money that would per se like wipe you out or anything. So, um, that's a good strategy. Like a lot of people that I know of, like they don't keep their ratios in check. Like SMCI, I would classify as one of like the highest risk plays you could do, but it has a very high reward potential. But if you tell someone online like, "Hey, I might do a play on SMCI," they might have a $10,000 portfolio and they say, "Okay, I'm going to go buy 10,000 bucks worth of calls on it." And then the stock goes down and the calls expire out of the money and they just lost 10K. But the difference with you is like you have some shares and I think you said you sold some puts, so you collected that premium and now you could take that premium and go buy shares of VOO or Triple Q or IWM, like you said, or even buy more shares of SMCI. So risk management is key and not over leveraging options and stuff like that. Um, let's wrap up with one more thing on my alpha report that we sent out on Saturday. It's basically just like a current state of the market. The market's been going up like crazy lately, and how do we value the market? So one of the main things I look at, I mean, it's not the main thing, but it's an important thing, is the PE ratio. And people are like, you sound like Warren Buffett, you sound like an old fart talking about PE ratios, but you know the market's been going straight up lately and everyone acts like a genius in a bull market, but the P ratio does matter. So the forward P ratio of the S&P 500 is 22, the Nasdaq is 28, And the NASDAQ demands a higher PE because there's a lot more growth going on in there. So that justifies a higher PE. This line right here on the bottom, this is the forward PE ratio of the S&P 500. This is 2004 to 2024. So you could see, if you draw a line to the side, we are kind of at historically high levels. This is the trailing PE ratio right here. But I want to show you this chart right here. This chart shows you what interest rates have done since 1995, or sorry, since 1955, my bad. They went up quite a bit and then they went down quite a bit. And this was like the interest rate hiking cycle that we just had, but now we're starting to cut. And the thing about it is rates are like gravity on the stock market. So if rates go up, like right here, rates were at 17%. I know it sounds crazy, but this was during the Paul Volcker era where he raised rates like crazy to try to get rid of inflation. But if the stock market averages 10% per year and you could go get a CD or a bond for 15%, you could get a guaranteed rate of return in a CD or a risky 10% in the stock market. So that right there, if we correlate that higher, that's why PE ratios of the S&P were much lower at timeframes like that because interest rates were so high. But right now we have interest rates at roughly like 4.5%, and they're expected to go a little bit lower. That would indicate that it's like, do you want to get a risky 10% in the stock market or a guaranteed rate of return of 3.5, just say 4% in a CD? It's kind of like, well, 4% is not really worth my time in a CD, so I'll just put my money in the stock market. But as rates continue to fall, the CD is going to go from 4 to 3.5 to 3. Do you want to get a 3% CD or do you want to get 10% in the market? The spread becomes wider and people aren't really going to want to waste their time with, a CD or a bond. So that's kind of like the opportunity cost of not participating in the market at a time when, yeah, valuations are a little bit high right now. And you can see it on the chart here and here, but interest rates are technically historically lowish. Like if you average all this together, we are low and we're expected to go lower. What do you think about that, Cole? And how are you playing this? I mean, do you think that rates are going to keep going down, and do you think inflation's going to stabilize? And is AI going to help make companies more efficient, which means costs are going to go down, which means inflation will go down? Or what do you see going forward with stuff like that?
You know, I I have some money in a CD. We just put some money in a CD here about 2 months ago because at what point the rubber band is stretched so far back, and I know some people are sitting on cash waiting. They don't want to invest. They don't want to put, they're just sitting on it. They're waiting to see what's going on. So let's go to the 1 year. Let's go to the 1 year, year to date. I'm sorry. That's 28%. There was a time where I remember watching I think it was Squawk on the Street, and people were just pulling out. They were just pulling out when they got to their 12, 14%. And they were like, hey, I'm done. I'm pulling out. I'm pulling out with my year already. I got to 12 to 14%. I think it's too high. And this was, a couple months ago, and they were pulling it out, putting it in a CD, holding on to cash just because, it's getting so high and it just continues to go. And yeah, when you're in a full bull cycle, you're excited. You're happy. You're like, oh yeah, every day you look, you're green. But there needs to be red days. It can't always be green because it's just so overvalued. And
That money that you put into that CD, are you planning to use that for something, or do you need that in the short term?
so no, we did. We're probably going to use it to buy a house.
Smart.
But I think it's funny. Right when we put that money in a CD, Tesla was trading at $218 a share. So if you put that in there, let's see, Tesla was at $218 a share. It's at 480. That's a what 120%,
A lot.
120% gain in a 2-month period.
I still think you made the right decision though, because it's
Oh,
like
for sure.
the stock market could have went down, and it's like, let's say you put 200K in a CD and it falls, the market maybe crashes, I don't know, 50%. That would be crazy, but that could happen. And it's like maybe you needed that 200K, the whole 200K for the house, and now you got to sell at a loss, and you have 100K now for a house. Like if we look at VOO, if we look at this on a 5-year chart, like what if you would have put the money in right here at 432, and then the market dipped all the way down to, I mean, it's not a big dip, but it went down to 320 ish. Maybe you
Yeah,
said,
that's
all
still
right,
20%. That's still 20% at least.
yeah, that's what I'm saying. So it's like, look at this run here. I mean, the market ran up quite a bit. And the number one thing that matters, for what a stock's going to do in the long run, which I know this is an ETF, but it's holding stocks, is earnings. Earnings are what the number one thing is. And looking at year to date on the S&P, the earnings growth of these companies did not go up by 28%. So that's why we see right here that we're having multiple expansion where the P ratios are going higher. You can see right here, P ratios are shooting up, but it's hard to value. Like it's hard to say definitively what the market's going to do. But there is one thing that I like to look at, and it's not a thing that I weigh, everything on, but this is kind of like a local meter where it's like the fear greed index, and right now it's viewed as neutral. I disagree with this. I feel like I said right here, I feel like we're in the 67 category. So that's definitely in a greedy category, but you want to be greedy when others are fearful. So when this needle's over here, the market's probably on a dip. But when the market's over here, when the needle's over here, the market's pumping. So right now, I'm being a little bit fearful when others are greedy. And, you know, I think you made the right decision I think that was a smart move going into a CD, because the market, nobody knows what it would have did.
Yeah, and we're fine with that. It was essentially extra money. So it was like we have our investment money, and this was set aside specifically for this house. And I was okay with taking the 4% that we got in the CD, and we don't need it right yet. So I was okay with it again, and I had a conversation when you talk about that, be fearful when others are greedy and be greedy when others are fearful. And I have a buddy that I talk to every once in a while, and he has some money in his little Chase account, and he likes to use all that money to buy one stock, and then if it goes down $1 in a day, he freaks out and sells. And I go, dude, you can't just buy a stock and then it goes down $1 and sell it, or it goes up $1 and sell it, and with the money that he's using, it's a couple $1,000s that might swing in there. So I go, you got to buy something. Don't just buy something because you heard Jim Cramer on TV tell you to buy it, or somebody told you to buy it. I said, do your research. Look into companies that you might think, okay, hey, well, is this undervalued or is this overvalued? I don't want to buy this. I want to buy that. And I tell them all the time, I said, you're my favorite person to talk to, because you are the exact opposite of how I trade. The minute he sees it red, he sells. The minute he sees it green, he's buying. He's a FOMO buyer. He wants to, everything's going up. He wants to start buying that. And the next thing you know, it goes down. And it was on a trend of maybe 12, 13%. And then it drops 4% in a day. And now he's freaking out and sells instead of just holding it until it bounces back, to back to super micro. I just looked up. That's what I was on my phone. I was looking up, my buy-in price is $23 a share. That's my average cost essentially. And, what was it up to? It was up to 44, 45. So I had almost doubled my money in a couple of days, or, a couple of weeks, and it's back down. It went back down another, over the last 5 days. What's the last 5 days? Yeah. So we're down another 11%. He would have freaked out and sold. I'm okay. Again, I'm here for the long haul. And that's what we're here for. So
I like that. It's interesting how people react when stocks move up and down. They think super emotional about things. But let's wrap up this podcast for the day. Make sure everybody that's watching, you guys everybody's watching, subscribe below. Sorry, I was looking at this chart here. It's like that's when they did that's when they got busted for the thing. But yeah, make sure everybody subscribe below. We're going to do a podcast like 1 to 2 times per week. We're going to cover whatever's going on in the market right now. Cole knows a lot about the stock market. You know, I'm invested in the market too. So subscribe, guys. We'll see you later.
Peace.